Attention recipients, big news for November the 1st, 2025. On the 4th of July, 2025, Congress passed and the President signed into law the One Big Beautiful Bill Act of 2025, officially Public Law 119/21. As Americans aged 50 and above, this law deserves your full attention because it changes how several federal programs operate programs that touch everyday lives. From food assistance and eligibility rules to deductions and taxes, these new regulations are reshaping the financial landscape for millions of Americans. Whether you are retired, semi-retired, or still in the workforce, these updates can impact what you earn, what you keep, and what you qualify for. Beginning on the 1st of November, 2025, major updates take effect in the Supplemental Nutrition Assistance Program, commonly known as SNAP. The U.S. Department of Agriculture confirmed that the age limit for work requirement exemptions will increase. In the past, many individuals up to age 54 faced stricter work requirements if they did not have dependents. Under the new rule, that threshold rises to age 64. This means that able-bodied adults without dependents, often called ABODs, between 55 and 64, may now be required to meet additional work or training criteria to continue receiving benefits unless they qualify for an exemption. For someone who has relied on SNAP benefits to supplement income, especially in rural or lower employment areas, this change could have real-world consequences. Another significant shift applies to households with dependent children. Previously, caregivers of children under 18 were automatically exempt from certain SNAP work requirements. Starting November the 1st, that exemption will only apply if the dependent child is under 14 years of age. For grandparents raising teenagers, this adjustment means they could face new reporting or participation requirements. These updates may sound like administrative details, but for many families already balancing fixed incomes and caregiving duties, they represent a serious adjustment to household budgets. The goal, according to federal officials, is to encourage workforce participation among able adults while continuing to protect the most vulnerable. Yet for many Americans aged 50 and older, it adds another layer of paperwork and decision-making at a stage of life where predictability is valued most. The November rollout also affects how states can request waivers from the federal government for areas with limited job opportunities. Under prior rules, a state could seek a waiver if an area had a high unemployment rate or an insufficient number of jobs. The new regulation raises the bar dramatically. Only areas with an unemployment rate of 10% or higher will qualify. That change could hit small towns and semi-rural regions particularly hard, where job availability is often seasonal or industry-specific. States that previously qualified for broad waivers will now face tougher scrutiny, which could mean thousands of individuals losing temporary work exemptions. For many older adults helping support younger family members in these areas, this shift may indirectly affect their households as benefits and eligibility ripple through multi-generation living situations. Beyond food assistance, the One Big Beautiful Bill brings major changes to federal tax policy. Beginning with the 2025 tax year, there is a new additional deduction for older Americans. Individuals age 65 and older can now claim an extra $6,000 beyond the standard deduction. Married couples filing jointly, where both spouses meet the age requirement, can claim up to $12,000 in additional deductions. For retirees living on fixed incomes, that's real money. Imagine a couple with a combined income of $65,000 a year. This additional deduction could reduce their taxable income enough to save several $100s money that could easily cover a few utility bills or several prescription co-pays. There's also a new deduction aimed at older Americans who are still part of the workforce. For tax years 2025 through 2028, taxpayers who are age 60 and older and still working may deduct overtime pay above their regular rate, up to $12,000 for individuals or $25,000 for joint filers. That provision rewards those who continue contributing to the economy while easing the tax bite on extra income. If you are, say, 68 and working part-time while collecting Social Security, this deduction could allow you to earn more without losing as much to federal taxes. The bill recognizes that more Americans are working later in life, not because they have to, but often because they want to stay active and maintain financial independence. In addition, there's a new deduction for vehicle loan interest. If you purchased a qualified personal use vehicle in 2025, you can deduct up to $10,000 in loan interest payments, depending on income level. For many Americans in suburban and rural areas, a vehicle isn't a luxury, it's a necessity. This deduction can ease the cost of maintaining reliable transportation for work, medical appointments, or family responsibilities. Taken together, these tax changes reflect an acknowledgement that life after 50 isn't uniform. Some are retired, some are still working, and most are somewhere in between, balancing financial stability with rising costs of living. To put this in perspective, imagine John, a 68-year-old store clerk who still works part-time and occasionally picks up overtime shifts. Under the new law, John's overtime earnings qualify for a $12,000 deduction. Add to that the $6,000 senior deduction and possibly interest deductions from a new vehicle loan, and John could lower his taxable income by more than $20,000. That may reduce his federal tax bill enough to cover the property taxes on his modest home. On the other hand, Mary, an 80-year-old retiree living with her adult daughter, won't benefit directly from those deductions because she no longer works. But her household might still be affected by the SE&AP regulation changes if her daughter, age 57, faces new work requirements starting in November. These examples show how intertwined tax policy and social assistance can be, especially for multi-generation households. The Internal Revenue Service has confirmed that all new deduction changes will apply to returns filed in early 2026 for the 2025 tax year. That means it's crucial to start gathering documentation now. Proof of age, income statements, overtime records, vehicle loan interest receipts, all these will matter. Likewise, if you or someone in your household receives SE&AP benefits, your state agency will begin reassessing eligibility in the weeks following November the 1st. Many states have already issued notices advising recipients to prepare for the updated criteria. It's better to check your eligibility early than to risk a disruption in benefits during the holiday season. These regulatory changes are designed to modernize programs and close loopholes, but they also demand that Americans, particularly those over 50, stay informed. The reality is that paperwork, deadlines, and documentation will matter more than ever. The opportunity lies in preparation. Knowing your deductions, understanding your eligibility, and taking advantage of the lawful benefits you've earned can make a tangible difference. The challenge lies in navigating the complexity without getting overwhelmed. For millions of Americans, November 2025 will not just be another month, it will be a turning point in how assistance and taxation interact. For some, it will mean a bit more responsibility. For others, it will mean a meaningful reduction in taxes or a clearer financial picture for retirement. These updates remind us that federal policy isn't just politics, it's personal economics. Every adjustment to an eligibility rule, every change to a deduction limit, directly shapes the daily reality of American households. If this update helps you understand what's coming, take a moment to like this video and subscribe to stay informed about future changes that could affect your benefits, taxes, and retirement planning. Staying informed isn't about politics. It's about protecting your peace of mind, your savings, and your independence. The One Big, Beautiful Bill's November regulations are proof that what happens in Washington touches every American home, and being prepared is the smartest move you can make. For those relying on federal programs for stability, it's essential to recognize that the One Big Beautiful Bill also expands digital access for benefit management. Beginning the 15th of November 2025, The Department of Health and Human Services will roll out a nationwide pilot program allowing recipients to verify income and eligibility through a unified online portal. This will streamline updates for Social Security, ENAP, and Medicare Savings Program participants, reducing paperwork and in-person visits to local offices. For older adults living in rural areas, this means less travel and fewer delays in benefit renewals. Yet, for those without reliable internet access, the transition could feel daunting. That's why community centers and libraries across the country are preparing to offer assistance through the new Federal Access Support Initiative, helping individuals over 50 navigate these changes safely and securely. Another overlooked yet significant provision begins on November the 20th, 2025. The bill introduces new cost of living adjustments for federal pensioners and certain Social Security recipients, tying increases to a blended inflation index that factors in healthcare and housing costs more heavily than before. The Social Security Administration estimates that this formula could result in an additional 2% benefit increase for the average retiree compared to prior methods. For someone receiving $2,200 a month, that's about $44 extra modest, but meaningful when grocery and medical prices continue to rise. It reflects a small but long-awaited shift toward recognizing the real expenses older Americans face daily. The law also includes an important consumer protection update. Starting November the 22nd, 2025, financial institutions must provide written disclosure of all fees associated with federally insured retirement accounts, including 401(k), rollovers, and IRAs. This means no more hidden maintenance or transfer fees catching retirees by surprise. The Federal Deposit Insurance Corporation and the Department of Labor will jointly oversee enforcement. For individuals managing their own savings, this transparency could prevent unnecessary losses. Imagine reviewing your statement and immediately seeing a clear breakdown of each charge. It's a step toward fairness that has been years in the making. Lastly, the One Big Beautiful Bill creates an expanded home modification grant program through the Department of Housing and Urban Development, launching on November the 28th, 2025. Homeowners aged 60 and older with annual incomes below $75,000 can apply for grants up to $25,000 to install ramps, widen doorways, improve lighting, and make bathrooms safer. For couples on fixed incomes, these grants can transform living conditions and help them age comfortably at home instead of moving into assisted facilities. Applications will open online and by mail, with priority given to veterans and individuals living alone. It's a quiet but powerful change, one that acknowledges that independence, safety, and dignity matter just as much as financial security.